Last week, Federal Reserve raised their funds rate, we call it overnight rate here, by 75 basis points, which is one of the aggressive moves we have seen in the last 4 decades. Now, this is causing serious trouble across the global financial system, especially the emerging economies where they're already struggling with the rising dollar against their local currency. And if they have foreign debt, which pretty much every emerging economy has, this debt will become even more expensive to be paid off. What does it mean for Canada? So Bank of Canada is likely to follow the same path, and they will likely to increase their overnight rate by 75 basis points next month. What does it mean for housing market? What does it mean for Canadian economy? In this video, we're going to talk about that. Let's dive in. If you're new to my channel, my name is Yasin Nizami, and I make these videos to educate you as a common person about real estate market in Canada, some macroeconomics, some money matters, how the money works, how the financial system works, and a little bit of technology. So if you are interested in any of these topics, consider subscribe, and let's get back to our topic. All the analysts and experts were betting against Federal Reserve that they cannot increase the interest rates so aggressively because the system is highly leveraged. The system has a lot of debt, and rising rates will definitely make the existing debt expensive to roll over. But last week, Federal Reserve sent a clear indication into the markets that they are fully determined to tame the inflation down, whatever it takes. It may bring the stock market down, it may bring the housing market down, it may bring the economy down, but they are fully committed to tame the inflation. Now the question is, for how long? So they can only increase the interest rate to certain levels. Above that level, things will be collapsed completely. We are already seeing that things are breaking across the world, across the financial system. We are seeing the stock market down 20%, NASDAQ is down 20%. We are seeing the housing market is slowing down significantly in the US, and the mortgage rates are climbing up significantly. And this will definitely have a downturn effect on the economy. Now the problem is all of these indicators and data, they are historic in nature. They are lagging indicators. So when these policymakers look in the back mirror at how the economy is performing in terms of job numbers, unemployment rate, the GDP growth, then those are lagging indicators. It can tell you how we perform in the past, but not how we will perform in the future based on the rising interest rate. That's the dilemma we are seeing right now. And when we see Bank of Canada, they are going to follow the same path in terms of increasing the overnight rate by 75 basis points. This will have major problems in Canada, not only from the housing perspective, but also from economic growth perspective. For example, they are looking at, again, unemployment rates. They're saying, new jobs being added into the economy. The economy is strong based upon those statistics. But the reality is, if you look around, you can talk to a lot of people from different segments. They will tell you they're struggling with the higher cost of everything: fuel, material, labor cost. Everybody is struggling with the rising rate. And in this environment, economic growth is very difficult. If you're raising the interest rate, which will make your existing debt, whether this is residential or corporate or business, it's going to be very difficult to monetize that debt going forward. The housing market has already come down 13% from the February peak as per Korea's statistics. And we're seeing that this is going to further slow down. And again, a lot of buyers who are buying right now, they have rates locked from February, March timeframe, when the rates were relatively lower than what we have today. Okay, so if you look at fixed rate today, which is being offered by some of the major lenders, it's close to 5% now. Okay, the variable rate is close to 3.2, 3.3% now. So when Bank of Canada will increase the overnight rate by, let's say, another 75 basis points, this will move the variable rate over 4% immediately. To give you some context, if you were buying $1 million property, let's say 6 to 8 months ago, when the fixed rates were like 2.5%, based upon 25 years amortization and 20% down, you were supposed to be paying $3,500 a month as mortgage monthly payments, excluding all the utilities and taxes. If you recalculate it based upon today's fixed mortgage rate, which is doubled 5%, your monthly payment is going to be $4,500 a month. $1,000 difference in the matter of 6 to 8 months. That's the extent of mortgage tightening we are seeing in the market right now. And this will continue to get worse because the rates are going to go up, and a lot of people who are buying right now are using their previously locked rate. So when this whole lock period is finished, which is I think after September, we will see all the buyers will now see the mortgage being qualified at the current rate. So and keep in mind the stress test, it is going to be even more difficult. So let's say if you're buying a property on fixed mortgage rate, you will be stress tested at 7% in order to qualify. I know a lot of people are going for variable mortgage rate just because of this reason. Even if you take variable mortgage rate, right? Today, the stress test is 5.25 at a minimum, but if the variable rate goes above 4%, your stress test will be at 6% going forward. So this will make the mortgage qualification overall very difficult. Okay, even though if you're not buying anything, if you're renewing your mortgage, you will be renewed at a higher rate today than what you paid over the last 5 years. So your expenses will go up, immediately. Your monthly payments will go up immediately. So this will further slow down housing market for sure. But the question is, for how long? If it stays around for a long time, then of course this will have spillover effect across the economy, because we already have labor shortage, we already have higher inflation where labor is not enticed to travel and do work because they're paying high amount of gas prices to travel around. So I think this is going to be very difficult situation going forward. The recession is almost there. We're not officially declaring it, but if we keep going down that road, I think this will be imminent, that the recession is going to be there. So I think the question is, how long before Bank of Canada will reverse their policy decision. They are now looking at the lagging indicators, unemployment rates in the past, economic growth in the past, and how the households are keeping up with the rising rates based upon the historical activity. So I think after 2 or 3 quarters, we will see how the situation is getting unfolded, and then we will see how things will start getting reversed in terms of the monetary policy decision. So again, this is all my research. You can do your own research. Let me know what you think. If you like it, give me a thumbs up. If you don't like it, give me a thumbs down, and at least put your comments down below why you did not like my content, or you have any objection on any of my statements. So give me your views in the comment section, and I'll see you in my next week video. Take care.